So, you want to learn bookkeeping. Cash. By Dave Marshall. Cash flow and profits. I've been around quite a few businesses where my little cartoon buddy is the way they determined how much cash their business had available to spend. Calling the bank to determine your cash balance can get you into trouble as it is only an estimate of what your true cash balance is. Your balance in the bank could be much less than you were told by the bank due to the fact that not all the checks that you have written have been presented to your bank for payment by your employees and creditors. On the other hand, you might be pleasantly surprised due to the fact that not all the money you have collected has been deposited or posted to your account by the bank. These differences are called timing differences. Where should you be looking to determine the cash balance that your business has available for paying its obligations? Your own business records such as your checkbook or your cash reports. The bank should only be used to provide you with an independent method of determining that the balance you have is correct. This is done by doing a monthly bank reconciliation. Hopefully, calling the bank is not the method you use to determine what your cash balance is. Another practice I used to run across was where businesses issued checks to suppliers or employees knowing that they didn't have the cash available to pay them in order to get the supplier off their back, or get the employee to come to work. They would then hope and pray that some customers would mail them a check so that they could deposit the money they needed to cover the checks that they had already written and issued. Some businesses even had fancy schemes, where they had more than one business checking account and would write a check from one of their bank accounts with no actual funds available to another of their bank accounts and then write a check back from another of their bank accounts. I'll have to say that they were managing their cash, but not in a proper, responsible, and legal manner. In the old days, they could get away with these practices, but today with the modern computerized banking systems, these practices are sure to bite you in your tail. Most small businesses at times have been confronted with what is normally referred to as a cash flow problem. This simply means that they didn't have the funds on hand that they needed to pay their bills or employees when due. The cash coming in is out of sync with the cash going out. What are some possible causes? Customers not paying on time. A big customer check returned by your bank is not paid, bad check, an increase in sales, which is great but needs to be planned for, seasonal fluctuations in sales, poor customer credit policies, and the business operating at a loss all are factors that can contribute to a cash shortage, or also called a cash crunch. Will good cash management eliminate all cash flow problems? Probably not, but at least it alerts you to potential problems ahead of time and allows you to consider alternative solutions, such as short-term borrowing, that may correct the problem. What exactly is cash? I know you're saying, what a dumb question, but I was told in life there's no such thing as a dumb question. Cash is the balance of your bank accounts, savings accounts, money market accounts, certificates of deposit, currency on hand, undeposited receipts, and even your business petty cash fund. Note that some forms of cash may have restrictions on how fast the funds are available for you to actually spend. Even your regular bank accounts may have what are called uncollected funds, which means you may have to wait a few days before you can actually spend this money. Can a business making money, profit, also have cash flow problems? You bet your bottom dollar they can. Profit and cash are two different concepts. Technically, if you're maintaining your books on the cash basis instead of the accrual basis, your profits and cash flow will match more closely, but they still may have some differences resulting from accounting for such items as inventories and equipment depreciation. Even a very profitable business can have cash flow problems which, without corrective actions taken, may have to close their doors. Of course, a business continuously operating at a loss will more than likely reach a point where they are unable to pay their obligations and have to shut their doors. What's the difference between cash flow and profit? Profit is calculated by subtracting costs and expenses from sales and revenues. The recording of sales and their associated costs and expenses often do not coincide with when the resulting cash collected from sales and the cash spent for costs and expenses occurs. In a nutshell, we have a timing difference resulting in part from credit granted to our customers and credit from our suppliers granted to us. These timing differences often result in cash collections being delayed even though profits have been recorded on our books, resulting in a short-term cash shortage. In other words, we haven't yet converted all our profits into cash. So while profits are definitely important to the success of a business, so is the management of cash. The lack of either of these can result in a business failure. What's your point? Making a profit does not guarantee that you'll have all the cash you need to pay your bills. Profits and cash flow are both critical elements needed for a business to survive and be successful. Cash management. Good cash management is also just as important as making a profit. Great cash management is even better. What is cash flow? A business's cash flow is simply the money, cash, flowing in and out of the business during a period of time. The major inflow of cash to a business results from the sales to customers and the immediate payment, cash sale, or the later payment, sales made on credit, resulting from these sales. Other cash inflows may result from investors contributing cash, bank or other loans made to the business, and the sale of equipment and other fixed assets. Major cash outflows are purchases of inventory, manufacturing costs for products, and payroll. Some other outflows are repayment of loans and interest and purchases of equipment and other fixed assets. What type of cash flow would you like your business to experience, positive or negative? I know I insulted your intelligence. Of course, all businesses strive for a positive cash flow. A positive cash flow results when the cash coming in is greater than the cash going out during a period. The opposite case which you want to avoid is a negative cash flow where the cash going out is greater than the cash coming in. What is a cash flow forecast? Budget. Another term often used to refer to a cash forecast is a cash flow projection. Whether we use the term cash flow forecast, cash flow budget, or cash flow projection, we're talking about the same business tool used for analyzing our cash. A cash flow forecast, projection or budget, is simply an estimate of the cash coming in and going out of a business during a period of time. What does it do for me? A cash flow forecast helps identify possible future cash shortages and allows you the time needed to take corrective actions. No, it doesn't have to be prepared using a fancy cash management or spreadsheet computer program, although in my humble opinion these tools, if used properly, make the job easier and less time-consuming. Preparing the forecast, whether manually or with the help of a computer program, does require you to analyze your business financial records and future plans in order to come up with any meaningful estimates and assumptions used for preparing the cash flow forecast. As with most things, your cash forecast tool is only as good as the data and assumptions used in preparing the forecast. If I had only one business tool to recommend to my clients, aside from preparing monthly financial statements, the cash flow forecast would be my pick. The importance of managing your cash is one area of business that cannot be overemphasized. What's actually involved in good cash management? Actually, it really only involves applying some good old-fashioned common sense. A few of the basics are: maintain an accurate checkbook, register or cash summary record. Make daily bank deposits and deposit your receipts intact. Don't pay bills with cash out of your cash receipts. Make all disbursements by check whenever possible. Prepare monthly bank reconciliations. Establish procedures for handling cash and ensuring that all cash is properly accounted for and timely deposited in your bank. Establish relationships with banks and other lending resources so you already have in place a source you can go to for help if you experience a temporary cash shortage. Strive to pay your suppliers and creditors on time. By building a good credit record and establishing a good relationship, they are more inclined to work with you if you encounter a temporary cash shortage. Establish credit terms and policies applicable to your trade or business and investigate and continue to monitor customers that you sell to and grant credit terms. Prepare a daily cash status report. If you don't have a lot of daily banking transactions, you may just want to prepare the report on a weekly basis. Analyze your cash needs and prepare cash forecasts, budgets to help identify possible future cash shortages and allows you the time needed to take corrective actions. Is there such a thing as having too much cash? Believe it or not, there is, but this is a problem that every small business wishes they had. I wish I had more cash than I knew what to do with, don't you? On the downside, excess or idle cash sitting in a bank does not make your business any money. You are in the business to make a profit, aren't you? This is no different than a manufacturing plant sitting idle and not producing any products. What should you do with these funds? If you're a conservatives type, you could invest in certificates of deposit, CDs, and at least earn something on these idle funds. You may, however, have better alternatives for the use of this cash. What are they? I don't know. No, I'm not copping out on you. I just am not familiar with what type of business you have. You and your financial advisors are the ones in a position to be able to answer this question. What should you now be aware of? A very important business concept: profits and cash flow are two different animals. Checklist for improving cash flow. Sell for cash or take credit card payments whenever possible. Establish a line of credit with your bank. Consider using a lockbox to speed up collections and deposits. Establish and monitor good credit policies. Prepare accounts receivable aging reports and use this tool to follow up on late payments from your customers. Likewise, prepare accounts payable aging reports and use this tool to schedule your payments to your suppliers and creditors. Pay when due but not early. Send monthly customer statements. Be aggressive in your collection efforts when you have to. Cut off additional credit sales to customers who are behind on their account payments, put a hold on their account. Bill promptly and accurately. Offer early payment discounts to your customers. Reduce inventory levels and sell off obsolete, slow-moving, or damaged merchandise even at a loss below cost if you have to. Lease instead of buy equipment. Purchase inventory, supplies, and equipment only as needed. Increase sales. Increase selling prices. Tighten or reduce your credit terms extended to your customers if you can. Take payment discounts on your purchases whenever possible. Sell off unused equipment and other assets not necessary or being used by your business. Use accounts receivable financing or factoring to speed up the collection of your sales made with credit terms. Negotiate and obtain lower payments and interest rates on outstanding loans from banks and other financial institutions. Review costs and expenses and reduce whenever possible. Keep on the lookout and check out new suppliers to see if you can obtain any cost savings or better payment terms without giving up any quality. Renegotiate for longer credit terms with current suppliers. Analyze products and divisions to determine if any product lines should be eliminated. Be alert to any new high-margin products that will fit into your line. Add late charges or finance charges to late-paying customers. If you have to borrow but have a plan for paying back these short-term loans. Follow up promptly and resolve any bad checks received from customers. Get upfront deposits for customers' special orders on any orders you can. Prepare and use cash flow forecasts as a tool for monitoring how well your cash planning is working. Note: these cash management tasks are continual and ongoing. Sorry you don't get to perform them once and forget about them. Cash and banking terms. Bank statement is the record that the bank maintains that records all the deposits and deductions that increase or decrease your bank balance during a specific period of time. See cutoff date. The statement is mailed out by the bank to its customers at specified time intervals, usually one a month. Cutoff date is the date that the bank determines and uses to prepare your bank statement as of a specified date. All your banking transactions, deposits, checks, and other adjustments that the bank has processed that have occurred prior to and including this date are included in your current monthly bank statement. All transactions that occur after this date are included in your next month's bank statement. Checkbook is a record that is used to keep up with the balance in your bank account and in which you record all your deposits, payments, and deductions that either increase or decrease your bank balance. Bank draft is a document that authorizes a deduction to be made from your checking account. A common example would be a draft that is taken out of your bank account each month for insurance. Check is a document used to transfer funds from one business or individual to another business or individual. The check is made payable to the payee, individual or business receiving the funds, and is signed by the payer, individual or business paying the funds. The check is drawn on a bank or financial institution where the payer maintains their checking account and the funds are transferred from. Deposit slip is a document used to summarize and record checks and cash received that are deposited in the bank. Deposit book is a record that contains the blank and completed deposit slips used for preparing the individual daily deposit slips. Usually the slips are treated so that a carbon copy is provided. The original is used for making the deposit in the bank. Bank fees are fees that a bank charges for providing various services to their customers. A common example of a bank fee is the monthly statement charge. Credit card fees are the fees that a business encounters in order to provide the capability for their customers to use their credit cards when making a purchase. The credit card service provider charges various fees to the merchant, such as a monthly statement fee, processing fee for each transaction, and usually a percentage amount for each transaction processed. Direct deposits are deposits that are sent to and directly deposited in your bank. The bank usually sends a notice to their customers to alert them that the deposit has been made on their behalf. A common example that many businesses should be familiar with is the daily transmittal deposit of all their customers' credit card sales processed by their credit card provider. Outstanding checks are simply checks written by a business or individual that have not yet been processed and cleared by the bank. In other words, they are checks written that have not yet gotten to the bank. Deposits in transit are deposits made by a business or individual that have not yet been credited to your account by the bank. Usually, this results from making a deposit for a day late in the afternoon or evening. When referred to when preparing a bank reconciliation, the deposits in transit are the deposits that have been recorded in the business's records but have not yet been recorded in the bank's records. NSF is an abbreviation for non-sufficient funds. This occurs when a check you receive and deposit in your bank account is later returned to you because the check was no good. In other words, your customer or whoever wrote the check did not have enough money in their bank account to cover the amount that the check was written for. Bank reconciliation is a record that is normally prepared each month after you receive your bank statement from the bank for the month. The record compares what you recorded in your cash records with what was recorded by the bank in your bank statement and provides proof as to the accuracy of your cash balance. Cash forecast, projection or budget, is simply an estimate that you prepare of the cash coming in and going out of a business during a period of time. Petty cash is a special fund that is set up to handle special payments. The special payments are small cash payments for unexpected expenditures or payments where access to a check is not readily available. Cash payments disbursements journal is a special journal record that is used to record all cash that is paid out by a business except for payroll. Small businesses sometimes also use this journal to record their payments for payroll. Cash receipts journal is a special journal record that is used to record all receipts of cash. General journal is the record used to record unusual or infrequent types of transactions. General ledger is a book containing the accounts for all of a business's assets, liabilities, equity, revenue, and expense accounts. Subsidiary ledger records keep up with the details of a general ledger's account balance, such as the details that make up the amounts that customers owe the business or amounts the business owes to suppliers. Two of the main subsidiary ledgers maintained by a business are the accounts receivable and accounts payable subsidiary ledgers. Accounts receivable aging report used to age and analyze how old the amounts are that customers owe a business and what amounts are late and may need attention. Accounts payable aging report used to age and analyze how old the amounts are that you owe to your suppliers and what amounts are late and may need attention.